Hello, this is Jerry Butler with Queenston Consulting. I'm speaking to you from sunny Winnipeg in Canada, Central. And so it's a good morning to everybody west, and it's good afternoon for Central and East. Today we're going to be talking about valuations, evaluations, and who's the perfect buyer for a business. We're going to actually do some calculating, so have a pen handy, and we're going to try and use a formula to get an estimate of what the value of the business that you're looking at, whether it's yours or somebody else's, is worth. Okay, Queenston, we're an M&A boutique. We specialize in financial advice industry. We've been doing this for about 7-8 years now. And before that, I was in the industry for about 20 years. We've worked with 150 plus clients over the last 5 years. And right now, we're certainly Canada's most experienced company in this space. As we go along, feel free to type in questions, and at the end of each section, I'll just check and see if there's any questions, and I'll probably answer them right then and there, because there's some very distinct components that you may have questions on those sections. Okay, today what we're going to try and do is, as I said, is get an estimate of the value. It's kind of a very abbreviated method of what we do here at Queenston, and we're going to try and identify, or you're going to try and identify some of the strengths and weaknesses of your business, and we're going to talk about who is the perfect buyer. The perfect buyer, just to give a thumbnail of it, is somebody that's going to pay, I would say, anywhere from 20 to 50% more for your business than the guy down the street. So it's always good to kind of position your business that would be attractive to the perfect buyer. When you're looking at any business, there's three very important measures, and one is transition risk. Once you buy that business, our client's going to continue to work with you, and that doesn't matter what kind of business it is. It could be a McDonald's, anything. The second thing is growth. Is this business, does it have the opportunity to grow? Obviously, you don't want a business that's declining. In our industry, growth is usually, not always, usually a factor of the average age of your client. So we're going to talk more about that. If your average age of your client is 75, your chances are pretty good your business isn't growing, unless you're in a very unique business owner market. And then the third thing is just basically supply and demand. Is there more buyers than sellers? And that's what you always want to be aware of. Okay, I'm going to read a question before we get started. And that is, I realize that the multiple of annual revenue method of evaluating the worth of a business might be slightly out of date, but based on your model of determining a valuation, if you were to do the backwards math and try to express it based on the old model, what would you say is a range or an average of valuations as a multiple of annual revenue? I am going to address that specifically when we get to precedent, precedents, in other words, the comparable companies, and I'll talk specifically about revenue. There's 4 different multiples that you can look at. One's revenue, top line revenue, one's recurring revenue, one's assets under management, and one is owner's discretionary earnings, which is what we're going to talk about shortly. Okay, keep in mind that this is real brief. Normally spend days working on valuation, not minutes. And we're going to use 2 methods today. One is owner's discretionary earnings, which is similar to EBITDA, except we take out all of the owner's compensation, and we'll talk more about that. And we're going to do a rough calculation on what multiple to use for the business you're looking at. And then the second method is precedent multiples, where we use actual multiples from businesses that that are in our database. Okay, here's the variables to come up with a multiple. And basically, we're using a binary system here. You're either going to get 0 or 1 for each variable. When I do this, I use way more variables than I do from 0 to 5. So it gets a little more complicated. Okay, the first variable, and you'll get the hang of this once we've done a couple, is predictable revenue. In other words, if you're doing recurring revenue, that could be fees, trailers, renewals, whatever, it's greater than 75% of your total sales, then give yourself a 1. If more than 25% is commissions, then you give yourself a 0. Second factor is operations. Operations are really, when you boil it right down, are 2 things. What we're looking at here is how can we minimize transition risk. And one is long-term employees, and the other one is an up-to-date client relationship management system, CRM. So if you have either one of those, give yourself a 1. And if you don't have an up-to-date CRM and you don't have an employee working for you, give yourself a 0. The third variable we're looking at is business model. Now this one is quite esoteric. It does mean a lot, but it's really hard to discuss and quantify. So the way we're going to do it today is say to yourself what your business model is, and then basically evaluate it. You know, are you good? Like if you're, say, financial planning, are you doing a good job with your clients on the financial planning side? Most everybody says they're a financial planner, but they don't do financial plans and they don't really talk about it. They probably have a sales model, not a financial planning model. But if you can identify it and you feel confident what you're doing, then give yourself a 1. Location. Location is huge for obvious reasons. You know, supply and demand is obviously going to be greater in a larger area than a smaller area. But if your trading district is less than a million people, then I would say give yourself a 0. If it's greater than 1 million people, give yourself a 1. Demographics are, in my opinion, the greatest determinant of potential growth. So if the average age of your clients is between 45 and 60, give yourself a 1. If it's less than 45 or greater than 60, you get 0. And number 6, same thing, demographics is your client profile. If you're dealing with professionals or business people, or average household income is greater than 200,000, or if they have 500,000 in savings, that type of thing. If you have a really solid client profile, then give yourself a 1. Financing. Right now, this is one of the keys why we've seen the values or the prices that businesses in our industry exchange for, and that's because financing has been available, and obviously rates are low, so it's very competitive. So if you have financing available, if you're going to be a buyer, or if your buyers have financing available, then give yourself a 1. And if the average household assets are greater than 300,000, that's also give yourself a 1. And if they're less than 300, then give yourself a 0. Check the top. Okay, the dealer, the platform you're on. That's this is a kind of a difficult one to talk about because it's fairly esoteric. But the way that I describe it is, if your clients are dealing with you and your business first, in other words, if I called them and said, who do you deal with? And if they said your name or your business, that's great. But if they say your dealer, then give yourself a 0. If your dealer has a stronger brand than you do, then that's actually a detriment to your business. So give yourself a 0 if that's the case. Another important variable when determining price, especially when you're selling, is how flexible the seller is and the buyer is on terms. And the way that I do valuations, I always start off by saying the price is going to be 50% down, and then the balance paid over 5 years, 4 or 5 years. But if you insist on getting more than 50% down, then you give yourself a 0 on this particular exercise. Okay, and number 11 is a bonus. If you answered yes to the demographic questions of age, profile, and average household assets, then you get a bonus. Give yourself another 1. If you didn't answer yes, then you give yourself a 0. And then divide by 2, and that's going to be your multiple. So remember that number. Okay, now we're going to calculate owner's discretionary earnings. And basically, owner's discretionary earnings are before the owner pays himself, how much money is going to be left after he's paid all his bills and collected all his revenue. So we do, it's called normalizing. We're going to normalize the P&L or the income statement. So you're going to take gross sales, subtract any dealer fees you have, any commissions or fees paid to other advisors. If you're doing joint work, or if you're hiring somebody to do your financial plans, that type of thing, then you subtract it off of your gross sales. Repeatable business. Repeatable business is really overlooked when people do valuations, when they get hung up on rules of thumb, like you know, what percentage of assets or what multiple of recurring revenue. Repeatable business is fees, could be fees that clients are writing checks to you for. They could be term contracts. As the term becomes due, then you have the opportunity to either roll it over or to convert it to permanent insurance, etc. So give yourself 50% of that amount, and subtract 100% of commissions. The number we're trying to find here is if I walked in to your bought your business and I started tomorrow, and I'm the world's worst salesman, then I'm not going to do very much in commissions. In reality, that's not the way it works, but that's the way I do the revenue adjustments. Okay, and that's going to give us our gross profit amount. And we also make an adjustment to expenses. Take all expenses paid to yourself or to the owner, salary, vehicle, entertainment, excess entertainment if you actually are going out for lunch with clients, that type of thing, that's legitimate. Memberships, insurance premiums, health plans, those types. Travel sometimes too. I think sometimes we cheat a wee bit on travel. And any one-time expenses for legal, tax, marketing, etc. You might have done a corporate reorg and you got a large tax bill, or something like that. It's more of something that's not going to happen on an annual basis. And then also interest, amortization, and taxes. You subtract all those from your total expense, and you're going to have your adjusted expense number. And that's going to give you, subtracting the expenses from the gross profit, it's going to give you your owner's discretionary earnings. And then you can, times your multiple, and it's going to give you a value. And that's plus or minus 10% roughly because of the way we did it. But that's going to give you a pretty good idea of what your business is worth as a turnkey operation. In other words, what's the intrinsic value? If I bought your business, how much money am I going to make, and what type of return can I expect? Somebody just asked, are we going to get access to these slides? Yes.
We uploaded to.
Yeah, we're going to upload it to YouTube, and I'm not sure how it works on WebEx, but yeah, we will definitely give you access to that. Okay, now we're going to talk about precedent multiples. In other words, other businesses, other financial advice businesses that we've sold, we've done valuations and transitions on, that type of thing. And so we go to our database when we're doing a valuation, and we find similar companies in similar cities with similar business models to the one we're doing a valuation on. Today, I'm just going to use kind of group a whole bunch together and come up with some averages for you. Okay, if you have mostly investment business, in other words, you're either not doing any insurance or you're doing very little, we found that 2.7 times top line revenue. And I mean top line, not unless you're in a transaction-oriented investment business. I'm assuming you're not, because those are few and far between. 2.7 times revenue for your own business. Take your recurring, your fees and trailers and renewals, 3 times 3.3. Use 2.5% of assets, and your owner's discretionary earnings use 4.2 as a multiple. So you do that math, you add it up, you divide by 4, and you're going to get a rough estimate of what similar businesses to yours have sold for in the marketplace. If you're doing a mixed business of investments and insurance, and I mean like maybe 60-40 or even 70-30, then the revenue is going to be a little bit lower multiple because of all the commissions, but we found that 1.6 gets us pretty close to the selling price. 3 times recurring, 2.4% of assets. Now, the reason the assets under management, the percentage is basically the same, is because sometimes on a mixed business, a generalist business model, the buyer is just buying the assets. That's all they care about, and they're willing to pay a little bit more. And the owner's discretionary earnings is going to be a little bit less at 3.4, but again, do the math, total it up, and divide by 4. Any questions? Type them in if you have any questions. Okay. Yeah, we're going to have lots of time at the end. Well, we're almost at the end, but you're going to have lots of time to ask questions and answer them to help you out. Okay, now you've done two different calculations, and they should be pretty close. Within plus or minus 10%. And if not, there's something wrong. And it could be, just it could even be your business model, frankly, that's a little bit different than the averages. Now, I will say this, and I can't stress this enough. The selling price can be materially different from the valuation amount. And that could be supply and demand, the flexible terms in the agreement, or if it's a perfect buyer that's buying the business. And right now, in most areas, it's a seller's market. There's more buyers than sellers. And so normally, if somebody goes through the proper process of selling their business, they should be able to have 2 or 3 qualified and interested buyers, and they should be able to get top price based on the number of buyers they have. Okay, let's talk about value drivers. What are the important attributes of a business in our industry, and what should you be looking at adapting your business to, or if you're looking to buy, what you should be looking for? Business model is very important because if you can't define the business model of a business you're looking at, or if it's your own, then it's not necessarily going to be a fit. But if you have a specialization that you're successful at, whether that be in investments or certain kinds of investments or insurance or different categories of insurance, then it's easy for a buyer to slot your business into theirs and make it work. Again, demographics are a big part of what you should be looking for. Now, demographics is the one thing that's almost impossible to change once your business is established. So what you want to do is make it as efficient as possible. Obviously, if your clients are 65, you're not going to be able to adjust that downwards, unfortunately. But that's not necessarily a bad thing. It's that when you buy or when you sell, you have to recognize that there's not a lot of growth in that, unless under certain circumstances, if you can access the intergenerational transfer and that kind of thing. But most of the time, I would say you have to make a decision. Do you want to buy especially when it gets up to around 70 years old, do you want to buy a service book and basically make money on the recurring revenue, even though it may be slowly declining over the next while, or buy a younger book if one's available, and that you can grow with your clients. Recurring revenue per household. This one is so important. I see all the time, especially businesses that have bought a couple of businesses, or if they've been around for 30 plus years, they're going to have a lot of small clients, a lot of people they don't make a lot of money on, and they're still in their book. What I recommend is to clean your book up. You sell the smaller, the D clients, maybe even the C clients, and the irony is what's left over is probably worth the same as the total, because you're going to find more and better qualified interested buyers. A buyer that has a successful business and doesn't want to buy a business where they're going to have to run around and see clients that have small accounts. So you're better off selling those separate, or even less productive assets. It could be group insurance. It could be old whole life policies, that kind of thing. You would know your business better, but you can sell them off. You can make some money for somebody who actually wants that be in that market, and the core of your business is going to be worth just as much or even more. And I can't talk enough about long-term licensed employees. And the reason is they usually know the clients better than the advisor. So if somebody's going to buy your business, they know if you get hit by a bus, at least the employee is around to make sure that the transition goes as smooth as possible. And finally is flexibility of terms. People right now get hung up on multiples and price and stuff like that. It's actually the terms that are going to dictate whether you got a good deal or not. And that can include a lot of things: keeping your staff, renting your office from you, or taking over a lease, et cetera, or you know, office equipment. Go right down the line. There's a lot of possibilities there to make the deal a win-win for both sides. Okay, I'm just checking questions now, and if you have any questions so far, fire them. Have you done valuation? Oh, hang on. Can you go through a real world example based on that calculation? To be honest with you, the numbers I gave on the precedent multiples, those are based on real world examples. Now, I can further address issues you might have. At the end, I'm going to offer you, to get a hold of me and book a half-hour conversation, and we can go over your numbers, and I can get way more specific in how it applies to you. Now I got to ask the question: have you done valuations and transaction for advisors at big bank dealers such as RBC, DSC, CIBC, Wood Gundy, BMO, TD, Scotia? I have worked with bank brokers, but and I have negotiated transitions, and the only time I've done valuations, though, is in the case of divorce. So I wouldn't call myself an expert, but the other thing about the big banks, the bank owns the clients. Now, technically they don't, I know, but it's very difficult to move. The other thing the banks do is they dictate the prices, and finally, they don't allow certain things. Most businesses trade as a capital gain, as an asset sale, but banks don't. They sell at an income stream and buy. So it makes it very difficult for bank brokers to buy outside of the banks or to sell outside of the banks. You basically would have to move your clients to a different non-bank dealer and then sell. I hope that helped. Okay, we got some more questions. This is good. Have I worked with Manulife Securities? I have quite a bit. Worked with Manulife on both buying and selling and valuing. So the answer to that question is yes. In fact, I have done some work with senior management at Manu, so I'm very familiar with their business model. I'm getting asked here, would you go into more detail regarding goodwill? Yeah, that's a good question. Basically, in our industry, when you sell your business, that's almost 100% goodwill. I mean, outside of some office equipment, which probably isn't worth very much on market value, and you're not going to pay much for it, everything else is goodwill. So it's an intangible. It's from an accounting and from a tax perspective, there's some different terms than a tangible asset, but basically it's treated the exact same. It ends up, whether you're buying or selling, they're hard assets and intangible assets basically are the same. So when you buy or sell in our business, you're buying or selling goodwill. I hope that helped. Okay, so we've talked about a couple different methods to value, and we've talked about some of the key drivers that are going to determine your price. What do I keep doing around here? Sorry. Right, okay. Oh. Okay, let's talk about the perfect buyer for a little bit. This is something that nobody ever talks about. I've been asked to recap owner's discretionary earnings, and I'll do that right after I talk about the perfect buyer. The perfect buyer is, as I said at the outset, they're going to pay, and I'm not kidding when I say they'll pay up to 40 or 50% more than, say, the average multiples. Now, you're not going to pay that for an average business. They're buying an above average business, but that gives you an idea why it's so important. And what are they looking for? They're looking for economies of scale. In other words, just to use round numbers, if your revenue is $100,000, they're going to take that exact same revenue and maybe they're going to make $120,000. Either they can charge more, they have a better grid, they're going to be able to reduce your overhead, and frankly, it's cheaper to buy than build. So they're going to recognize that, and they're going to pay you a premium for your business. The other thing they're looking for, buyers are looking for, they could be looking for, is the synergies. Synergies is, you know, where basically the definition of synergies is the sum of the parts is greater than the whole. Or excuse me, the whole is greater than the sum of the parts. Okay, for instance, if you're in the same target market as them, but you're doing something a little bit different, your marketing is outstanding. Maybe you have a different specialty than them, and you can cross-sell going into with your business. Your business may complement theirs. And there's one of the big things now as far as complementing is even different locations. Many advisors are looking at multiple locations now. And frankly, you may have something they want. It could be your business model, it could be employees, it could be your location, your office, and they're looking to get bigger is better because they're going to make more money on the same amount of revenue as you. And that the third thing that I always use is to change the buyer's life. If you're an advisor, and let's say for argument's sake, you're managing 30 or 40 million, you know, after you pay your assistant, et cetera, and your office and your overhead and everything, and you're not happy with what's left over for you, if you can buy a business and say double your revenue, and maybe your expenses only go up 25%, then you've just changed your life. So those buyers, and usually those are very newer people, but really good business people, and they get it. One of the things I want to talk about, I don't have a slide for it, real quick, is what a perfect buyer is not, and what I see advisors do all the time. Number one, it's not the easiest person to sell to. It's not the guy down the hall. It's not the person you think is doing lots of revenue and they're doing really well, so they're going to buy your business, because they're not going to pay as much for it. Especially if you approach them, they have all the leverage. That's not who you want to sell it to. The other thing you don't want to sell it to, or type of business you don't want to sell it to, is somebody that doesn't have as good a business as you, and is not going, you're not going to be happy with the job they do. So try and find the perfect buyer. Oh, sorry. Okay. What I'm going to do is I'm going to summarize the owner's discretionary earnings again for our question. Okay. Basically, owner's discretionary earnings is a function of calculating what the intrinsic value is. In other words, if somebody buys your business and they walk in the door tomorrow and you walk out the door, how predictable is the revenue and expenses? And that's basically what we're trying to do here when we normalize the income statement. We have a multiple. Think of the multiple as this: the greater the, if we go down here, the greater the multiple, the higher the value. So if the multiple is 5, that basically means on owner's discretionary earnings, you're making 20%. If the multiple's 4, 25%, you get the picture. If the multiple's 2, it's 50%. And that multiple is a function of risk. The transition risk, no growth, maybe no supply and demand. So the multiple is going to kind of determine the price based on your return on investment. I hope that helps. What was his name? Colin. Okay, let's get to the summary page. Whoa. Okay, yeah, so what I've tried to do is give you a little quick back of an envelope way to estimate value and price. The other thing is, if you're looking at your business and if you have a 3 to 7 or 8 year time horizon, now's the time to start thinking about these things to make your business have more curb appeal. Let's say, it's going to look better to potential buyers. You may even start talking to buyers now. That could be somebody that's going to come in as a partner, buy you out over time, et cetera, et cetera. But the key is to make your business as attractive and as efficient as you can, both for yourself, your family, and it frankly is better for your clients as well. Okay, one of the things I'm going to do is anybody who would like to talk about their calculations and ask some questions, that type of thing. It's a lot easier when we're talking one-on-one than this method. So I'm quite open to booking phone appointments and we can review. But and if anybody has any questions, type them, fire them off, because I got a couple more here. Yeah, I'm getting asked to go back to the owner's discretionary earnings screens, and I'll do that. And then you can type your, I'm guessing it's the variables. So you can, who was that? That was John. So John, if you want to type another question, or I don't know if you just want to take a look at it. But basically, I'm using these 10, 11 variables to come up with a multiple. When I do it, I do it with about 25 different variables, and it's not 0, 1. I do it on a scale of basically 1 to 5. So it's a little bit more analytical, perhaps. The second part is going to adjust revenue and expenses to try and calculate how much money is going to be left over in a normal year as far as revenues, normal revenues, and all the expenses are basically to keep the business going. They're not you know, paying my salary or anything like that. Okay, any more questions? Okay, now one of the things, if Myra's here to help me, she's my assistant.
Hello.
What do they do if they want to see the webinar?
I'm going to send out a follow-up email to everybody that registered with a link to the video.
Okay, great. We got a couple more questions here if you want to hang on, people. Got somebody's asking here if it's paid over a period of time, is the tax due up front, or can you be paid as a consultant? The answer is yes to both. You can pay the tax up front if that's what you want, but you can also spread it over, I think it's 3 or 4 years that you're allowed. That's on an asset sale. And if you're paid as a consultant, that's an income stream, and you can, that may, in different situations, works out different, but it may be tax efficient for you as well, especially if you set up a corporation, if you're not incorporated, and have the consulting revenue go into your corporation, and gives you some flexibility as far as on the income tax side. Okay, and then somebody shot me off their number, phone number, to give them a call. We'll write it down, and I'll try and call you on Monday, but it's a lot easier if somebody wants to talk to me, they call me, and my phone number is 204-889-1189, and you can try me, and if you don't get me, let's leave a message and we'll get back to you. Okay. Do we have any more questions?
I think so.
Oh. Okay, I'm being asked here on the what else could be a variable using the illustrations. I'm assuming they're talking about, again, owner's discretionary earnings. What else could be? Well, operations alone, I have about 7. I'm looking at employees. I'm looking at, are they licensed? I'm looking at technology. Do you have an up-to-date CRM? Do you have a wealth management program? The CRM, if it's your dealer CRM, that's a bad thing. That's not. It's better than nothing, but it certainly limits who you can sell your business to. I look at what financial planning software you're using. Are you actually doing financial planning, et cetera, et cetera? And you can go right down the line. Business model. I'm looking for branding. I'm looking for how many appointments are in your office versus outside your office. So it gets pretty time-consuming, and so I hope that helped. Is that
I think that's it.
okay? I think that's pretty much it. Thank you very much for your time. Like I said, if you have any questions, email us or phone us, and we'll try and help you out. Why isn't this opening?
Yeah.
Oh, there you go. This is a really good question. I hope not everybody's left. Do you find most sales are asset or share sales? That's probably more are asset sales, but so much of it depends on your dealer, on whether you're MFDA, IROC, or whether you're not licensed for securities, insurance, et cetera, but I would say more asset sales than share sales, though. So share sales are much better for the seller, and they're both the same for the buyer outside of some liability risks that can usually be addressed through your accountant. But my time's up. Thank you very much, and please let us know if you have any more questions. Give us a call. Thank you very much.